estate department, and I was invited to present and teach this homebuyer education class. I was extremely excited about it. This is a big passion of mine. Just so all of you know a little bit of my history. So I started in real estate about 3.5 years ago, and I had no experience in real estate whatsoever prior to that, my first job. And I remember being so confused and stressed out, and I wasn't even buying a house. And I thought, oh my gosh, what if someone was buying a house and they didn't know the process? And so, like I said, it's become a big passion of mine just to teach people how you get from start to finish, what happens in the middle, what the bank looks at, all those little details. So I'm hoping tonight we can answer some of your questions. As we're going through things, if anything pops up, like Corey says, use that chat function and we can address those questions. There will also be some time at the end for some questions, so if you want to hold it till then. And then I always like to offer, buying a home and working with your finances, there can be, private information that you don't want to chat about with a group. So don't ever hesitate to contact me. This is my direct line and that's my email address. So again, please don't hesitate to reach out to me directly if there's something that you have questions about. So we'll get right into it. Let's see. Okay, so home loan steps. How do you get from start to finish? What to expect and what happens during the steps? So I'd say buying a home can kind of be broken down into 5 different steps. The first piece being pre-qualified. We'll talk about that in detail. Second piece is home shopping, processing, underwriting, final approval, and closing. So what happens during pre-qualification? You go to a bank, a lender looks at your finances and lets you know what you're qualified to purchase. So they'll say you are qualified to purchase a home amount for X amount of dollars and a loan amount of X amount of dollars. They'll also let you know a loan program, any sort of down payment assistance that you might qualify for, that sort of thing. This is a great time to shop mortgages. So go talk with a couple of different lenders, see what's available. And then from there, begin your home shopping. With home shopping, that's kind of the exciting piece. That's where you go out and work with a realtor, tour those homes, find that dream one. At this home shopping step, this is kind of the first phase in the home buying transaction where you will actually put some money in. It's called earnest money. That money comes back into the transaction as long as all the contingencies are written in the buy sell and nothing happens. But just know that's kind of your first piece where you'll have some money put into the transaction. After you go under contract on a home, so you have the buy-sell agreement, signed between yourself and the sellers, your file then moves through, your loan file then moves through a couple steps at the bank called processing and underwriting. So at the processing step, what happens is a processor looks at your loan file and says, something like, hey, we maybe need some updated pay stubs, or maybe we need another bank statement. Once we've gathered all that documentation from you as the borrowers, we then assign your file to an underwriter. And the underwriters, a triple check on the file. They're checking to make sure income is calculated correctly. It's a major compliance check, where all the I's dotted, T's crossed, just all the fine details. The underwriter, after they've reviewed everything, they will then assign the file back to the processor, and they'll say, okay, great, I can approve this file if these conditions are satisfied. So at that point, your processor and your underwriter on the processor and the lender on your file will reach out to you and say, maybe we need some updated pay stubs, maybe we need some updated bank statements. I always joke, but I'm somewhat serious. During this process, we'll ask you for every piece of financial info you've ever thought you've ever had, and then we'll ask you for more. And then you're going to be like, Hillary, quit asking me for this stuff. And then I'm going to say, what's your shoe size and your dog's name? And you're going to be like, this woman has lost her mind. But just know that we have to document every single little thing in your finances just to make sure that you do have the ability to pay that loan, that sort of thing. So anyways, long story short, after the processor and the lender get everything, they then assign the file back to the underwriter, who reviews the file for a final time, gives it final approval, and then that's when you actually close and buy your house. So this is kind of the final really exciting piece. We talked about this a little bit, but what happens during pre-qualification? So again, you go talk with a lender, you'll complete an application with that lender. They will ask you for financials to support your application, and then they will analyze those financials and let you know what you're qualified to purchase. Again, they're going to let you know the dollar amount of the home that you're able to buy, the loan amount that you're qualified for, and they'll also talk to you about the programs that you're qualified for. The lender will issue a pre-qualification letter, and that will also document those numbers. But if you ever lose that or have questions on it, give your lender a call. So what documents can you expect to provide at pre-qualification? So again, completing an application. You can usually do that with your lender. Some of them might have you do it online. I know at First Security Bank, we have a phenomenal online application. Really simple, just steps you right through the application. So that's one piece of it. Some other things, depending upon your finances and how you earn money, kind of drives what documents we need. But some things to expect would be pay stubs covering the most recent 60 days, your 2 most recent bank statements. So, 2 most recent months that those have been issued. In some instances, we maybe need your tax returns for the last 2 years, your W-2s for the last 2 years, and that'd be for all jobs worked, not just, the one that you're working in currently. If you've had more than one job in the last 2 years, we'd want to see all of those W-2s. And then for any self-employed borrowers, what we're looking at is your 2 most recent years of business tax returns, a year-to-date profit and loss statement, and then your 3 most recent business bank statements. So a little bit of extra verification there on that self-employed. But this kind of gives you an idea of the documents to start to gather and pull together for that pre-qualification, and also just the loan file in general. So when you go get pre-qualified, the lender looks at lots of ratios. I always kind of joke we're really nerdy when it comes to numbers, and ratios, one of our favorite things to look at. And the debt to income ratios are the really big numbers that we look at when qualifying individuals. And so we look at 2 ratios when it comes to debt. One is the front end ratio, or also known as the housing ratio. And then the other is the back end ratio, or your total debt. So the housing ratio, the way I like to explain this is the housing ratio gets you into the house. So can you make that mortgage payment? The back end ratio, or total debt, is, all right, you're in the house. Now, can you live in that house and still pay all of your monthly debts? The max housing ratio is around 40%, and max total debt is roughly 50%. But just know that depending upon the loan program that you're qualified for, these numbers might be different, whether that be higher or lower as to how far we can push those. So we can just go through a really simple example here. Let's say this particular borrower has a housing ratio, again, the front end of 36%, and then they have a back end or total debt ratio of 42.5%. So in this particular example, let's say their mortgage payment is $1,800 a month, and then they have 2 debts. They have a card payment of $300 a month, and then the minimum payment on their credit card is $25. This particular borrower, let's say they make $60,000 annually. So when we look at gross monthly income, that's before taxes, they're making $5,000 a month. So when your lender looks at your finances, they're going to calculate these numbers. So for example, in this instance, the housing ratio, they're going to take your house payment divided by the gross monthly income, which we have expressed here, and that's 36%. Total debt to income, again, your total house payment plus total monthly debts. So in this example, you have your mortgage payment, the car payment, the minimum credit card payment divided by their gross monthly income. That puts them at a total debt to income ratio of 42.5. Again, really important numbers that your lender looks at when they qualify you. So, you can maybe kind of calculate those on your own. It might be fun to think about, if I make, $60,000 a year and my rent is, $2,000 a month, where does that put my house ratio? Another ratio that we'd like to look at is loan to value ratios. So what does the loan to value ratio tell us? Well, specifically, it lets us know kind of how much equity is in that property. A big piece that loan to value ratios tell us is whether or not the borrowers will have to pay mortgage insurance. Now, I don't have any specific slides on mortgage insurance, but let's talk about it a little bit. So mortgage insurance, a really negative way to think about mortgage insurance is it's actually default insurance. So if you quit making your mortgage payments, your house went into foreclosure and you defaulted on the loan, this mortgage insurance would actually help pay the bank back for the loss on that loan. Now, again, super negative. Why are we thinking that you're not going to make those payments? Because you're stellar people. We expect you to make those payments. Positive way to think about it is mortgage insurance allows borrowers to get into homes without 20% down. And in our market, with as expensive as houses are, 20% down is, could you not, like impossible to save, right? So that mortgage insurance just really helps overcome that down payment gap. Ideally, if you have your 20% down or your 80% loan to value, is another way to think about it, you would not pay mortgage insurance. So let's look at a couple examples. I hope I don't just bore you guys to death with math, but I'm a big math nerd, so I like to look at numbers and equations and all that. So if I get too boring, stop me and we can move along. But in this first example, let's just say this particular borrower is buying a house for $450,000. They have their 20% down, so their loan amount is $360,000. How we calculate that loan to value ratio. So again, you have your loan amount of $360,000 divided by the value of the house, and that gets us at 80% loan to value. So in this particular example, that borrower would not pay mortgage insurance because their loan to value is 80%. Now, next example, let's say the borrower has 5% down. So in that case, again, let's say this particular person's buying a house for $450,000. They have 5% down. That puts their loan amount at $427,500. So in this case, their loan to value ratio is 95%. In this example, this borrower would pay mortgage insurance. Now, let's look at this final example. So we actually look at two different loan to value ratios in some instances. So a big one is if a borrower is getting down payment assistance. Let's say somebody maybe has what's called a HELOC, a home equity line of credit on their house. We'd look at this a second loan to value ratio here. But in this particular example, we're just going to look at loan amount, the borrower is getting down payment assistance, and then the value of the house. So again, buying the house for $450,000. Let's say we're looking at a scenario where we're looking at 5% down. So again, loan amount at the $427,500. And then this particular borrower is getting $21,375 in down payment assistance. So if we look at just the first lien, just the mortgage, again, loan to value is at 95%. But now let's look at what's called the combined loan to value. So all of the liens or all of the loans that are tied to this particular property as the collateral, what's the total of those over the value of the house? So in this instance, again, we just look at the loan amount plus the down payment assistance, divide that by the house, and that gets us at a combined loan to value ratio of 99.75. Again, in this particular example, this borrower would pay mortgage insurance. So mortgage payment, when you make your monthly mortgage payment, what is covered? Lenders like to call mortgage payments a PITI payment, and that stands for principal, interest, taxes, and insurance. And we'll get into the definitions of those. So principal is the amount borrowed or the remaining unpaid loan balance. Making any additional principal payments can significantly reduce the interest that you pay on that loan and the loan term. I can't remember the example, but it's something like if you make one extra mortgage payment to principal every year, it cuts something like 7 years off your mortgage. Or, don't quote me on those numbers, but if you go online and search like an amortization calculator, it's kind of fun to play around with and say, all right, if I'm really diligent and I put $100 every month towards principal, how does that affect my loan? And it's really shocking how that adds up. Again, just decreasing the amount of interest that you're going to pay over the life of the loan and the loan term. So interest is a percentage rate. It's paid regularly. So every month you make an interest payment, and that's just kind of the cost to borrow that money. Right now, interest rates are still, fantastic. So good time to buy because we're still seeing some low interest rates. Definitely helps, with these PITI payments. Another portion that's included in your monthly payment, again, principal, interest, taxes is what we're looking at now. Taxes would be county taxes and in some instances, city taxes. So some areas in the city of Bozeman, you do pay city taxes, county taxes, whether that be Gallatin, Broadwater, Jefferson, Park, wherever you're looking to buy, whatever county that house resides in, you'd pay the annual taxes on that. So again, that's included in your monthly payment. And then insurance. So this insurance is the homeowner's insurance. So this protects your home in the event of a loss. An example of loss is a house fire. So this is the kind of insurance that covers you as the homeowner, like I said, if anything were to happen on the house. Now, a couple other things. Again, we talked about mortgage insurance a little bit earlier. Mortgage insurance is escrowed. So what that means, it's included in your monthly payment. So you don't have to worry about paying mortgage insurance by yourself. When you make your monthly payment, it gets applied to that. One important thing to know is HOA dues are not escrowed. So HOA stands for Homeowners Association dues. Another way that they're sometimes referred to is a PUD, a planned unit development. What these are, and where they typically happen is like if you're buying a house in a subdivision and there has to be, some income coming into the subdivision to maintain sidewalks. Maybe there's a park in the subdivision. Those HOA dues just cover those expenses, and those are not escrowed. So again, you are responsible for paying those on your own. It is not paid through your mortgage payment. So I get really, I always say I sound like my grandma when I talk about this, but it is a serious thing. Know your budget and know what your payment is. So if we go back, I'm going to rewind a little bit. So when we go back, when your lender pre-qualifies you, they're looking at your gross monthly income for qualification. So that's before taxes, that's before your, maybe your employer's taking money out to pay that insurance. That is before any deductions come out. So at your max pre-qualification, your lender might have your ratios at 40 and 50%. That means before taxes, 50% of your money is already going to debts. Now, if you are at these numbers, some people, quote unquote, call it house poor. I mean, that would be a significant mortgage payment and a tough nut to crack every single month. So again, just be extremely cognizant of your budget, know how much you can spend, know how much you're comfortable spending on a, house payment. And then when you are pre-qualified, let's say you go under contract on a house, know what your payment is going to be on that house. The lender will send you multiple disclosures documenting this, but if there's anything you're confused about, ask questions. Lenders are there to help you. So, if you have this information dialed in, we can help you get to that goal. All right, so let's talk a little bit about loan programs and the minimum down that's required on those. So if there's any veterans watching tonight, the VA program is phenomenal. It's a great benefit for veterans. There are some rules as far as qualifications. So, how long you served, what you served for, what your discharge was out of, the service. With the VA program, it's a 0% down. So that means you don't have to have any down payment. If we rewind back to loan to value, that would mean you're at 100% loan to value. So in the VA instance, you could buy a house for $450 and your loan amount would be $450. The next program we'll talk about is the rural development one. I get a lot of interest about rural development. It's a phenomenal program. Again, it's a 0% interest. So just like VA, if you're buying a house for $450, loan amount for $450. So you can do 100% financing on those properties. There's a couple of conventional loan programs that allow for 3% down, which is awesome. These programs are income restricted, so you can't make over a certain amount and still qualify for these. However, the income limits are reasonable. Lots of people are actually, probably qualified for this program. Again, 3% down. The two programs that are available, so there's Fannie Mae and Freddie Mac. That's kind of who loans are sold to. And their particular 3% down programs are Home Ready or Home Possible. The FHA program, that's extremely common. That allows for down payments as low as 3.5%. And then just traditional conventional financing, what you probably think of when you think of a mortgage, it's just your bread and butter mortgage. The minimum down payment on that is 5%. What I like to kind of make an analogy out of loan programs is, all right, you go to the grocery store and you're in the shampoo aisle, right? Now there's tons and tons of options, but you know which product that you like. And so you go with that because it fits your needs best. And that's kind of how loan programs are, right? You know, your lender is actually shopping for the shampoo for you, but you know, they're looking at these programs and they're going to say, okay, based on this borrower's financials, this is what benefits them the most. So just to kind of lead on that point a little bit further, you know, work with a lender that you trust, work with a lender that you feel good with. You know, if you have any hesitation or you feel weird about, you know, the relationship with them, you know, talk with some other lenders, see what's available out there. You know, this is the biggest transaction and biggest purchase you'll probably make in your lifetime. And so, you know, you really want to work with someone that has your best interest in mind and that is going to take good care of you. All right.
Hey, Hillary.
Yeah.
We have a great question for right now.
Okay.
Somebody wrote into the chat for first-time homebuyer programs, if one spouse has purchased a home prior to the marriage and the other spouse has never owned a home and they want to purchase a home together, would they qualify?
That's a great question. So it depends. If the spouse has owned a house greater than 3 years ago, let's say they have not had any home ownership in the last 3 years, then yes, you guys would qualify for first-time homebuyer programs. There is one program we'll talk about a little bit later if you guys are seeking some down payment assistance or, you know, looking into that. There is actually one program where you don't have to be a first-time home buyer, aka have not owned a house in the last 3 years. But again, if that individual has had ownership in the last 3 years, it would knock you out of the first-time homebuyer programs. And honestly, this here, this is a little misleading. I should have cleaned that up. So this is not just specified for first-time homebuyers. So, you know, if you're concerned about down payment, just know that there's some options and you can still benefit from some phenomenal programs if you're not a first-time home buyer. So that's an excellent question. Great job. I love the good questions. Any others, Corey?
That is all for now.
Okay, awesome. Well, I love it. Great job. All right, so we'll get into this next slide. So how much money will you need for closing? So I get this a lot. People come to me and they say, I have $15,000 for a down payment. Well, what they're actually saying is I have $15,000 total. You know, that's the max investment that I can put into this transaction. And a lot of times I think people don't understand the difference between down payment and then also closing costs. You know, I hear it all the time. You know, we were almost to closing and then my lender breaks this news that we have closing costs we have to pay. And oh my gosh, now I'm scrambling to come up with this money and trying to ask family members and all that. I mean, it's a common thing. And so I always like to really stress that in addition to your down payment, there's also closing costs and prepaid. So we'll talk about those here in a minute. Again, your down payment, I'm sorry, I'm jumping around slides, but it's all kind of interconnected. So your down payment is how much money you're applying to the purchase price to get you to your loan amount. So if we look at a really, really simple example, just simple math, let's say you're buying a house for 100,000, you have 10,000 down, that means your loan amount is 90,000, right? Or in these instances, you know, in this case, they have, what is that, 90,000 for a down payment to get to that loan to value ratio. So just to forward back. So down payment, again, just takes off from the purchase price to get you to your loan amount. Now, closing costs and prepaids, these are kind of the costs to get the loan. Closing costs, those are going to include, this is not an all-inclusive list, so there is likely additional fees listed on here, or that would be included with these, but you know, that's going to be things like paying for an origination fee, talk to your lender about that. They may or may not charge one. An appraisal fee, title fees. So do a title search on the property. Make sure there's no weird liens out there, that you will be, the owners on the property. It's also going to pay for recording fees with Gallatin County, whatever county you buy in. So just recording the documents at the county, again, and transferring that ownership to your name. It's going to pay for a credit report. What are some other things that those closing costs will pay for? A flood certification. If you're buying a condo, sometimes there's condo fees included in those. So again, closing costs are just the costs to get the loan and the services to prove everything. Now, prepaids, those are going to be items such as taxes and insurance and mortgage insurance. So again, county and city taxes, if the city taxes apply, homeowners insurance. So again, the insurance if you were to have a loss on the house, and then that mortgage insurance if you're putting less than 20% down. These are all part of that prepaid. And this is also funding of your escrow account. And so your lender's going to pay a full year of insurance up front, and then they may have to collect for some taxes. So that way, when those taxes come due, you have enough that's built up in that escrow account. I'm going to rewind a little bit. So with this PITI payment, what happens with the taxes and insurance? Every month you make your payment, this portion, the taxes and insurance, get deposited in an escrow account. And in that way, when those taxes and insurance bills come due, they're paid out of that escrow. So again, prepaids is funding that escrow account. So, if we're going to be a little bit off and we won't have enough to pay that, come November, that's you making up those months to pay that when those bills come due. This is a rough estimate, but for a purchase transaction, you can estimate the closing costs and prepaids to be anywhere from 2 to 2.5% of the loan balance. So that's just kind of a goal to use. It may fluctuate depending upon the program that you're in, but just kind of use that as a target, for saving for this portion of the transaction. Now that's a lot of money, right? And we live in an expensive market, so that makes it even more challenging. Rent is crazy expensive. How in the world do you ever come up with that kind of money, right? It's hard. So that's where down payment assistance comes into play. There's some phenomenal programs that are available. Again, just to kind of circle back on that viewer's question, there's some programs that don't require you to be a first-time home buyer. So again, this down payment assistance is really phenomenal. With this program, however, there are requirements. There's income maximum, so they don't want, some super wealthy person to be qualifying for these programs, because they should be expected to have their own money saved and that sort of thing. So income restrictions, it limits how much these borrowers can make. Has credit score requirements, so minimum credit scores that have to be, maintained for the borrowers. They have debt to income ratio maximum. So, some programs are extremely limiting in those debt to income ratios. There's also minimum borrower investments. Some of these programs require borrowers to pay 1% of the purchase price. So again, just kind of a goal. And if we were to look at, that borrower buying that $450,000 house, they'd have to, minimum investment, $4,500. Now let's talk about some down payment assistance programs that are available. These are some of the popular ones. The Home Now MoFi program, they have down payment assistance where you can either get 3 or 5% of the loan amount. And this is that program where you do not have to be a first-time home buyer. So phenomenal program. The nice thing about the Home Now one is you can go with, I'm going to rewind, a conventional loan program, which is really common. And then any of these, we call them government loan programs. So FHA, rural development, or VA. So really cool. That MoFi one covers all of those. The next program that's really common is through the Montana Board of Housing. It's a local loan, which is awesome. Borrowers can get either $10,000 or $6,500 in down payment assistance. Now, this loan or this down payment assistance program is only sold to government loans. So again, FHA, rural development, or VA. The HRDC the Human Resources Developmental Council here in Bozeman. They do things like the bus that you see around town. They do the warming center, really phenomenal program. They have a down payment assistance program where borrowers can get up to $30,000. This particular program has really strict debt to income ratio requirements and low income. So depending upon what you make, this one likely is not an option, but ask your lender about it. Always ask. You know, if this is an option, it's worth it. The Montana NeighborWorks Lift program, they have up to $10,000 in a forgivable loan. So that $10,000 can go away. And then the Home Start grant, that pairs really well with this HRDC loan program, can get borrowers up to $7,500 in a grant. A couple points that I failed to mention. So with this MoFi Home Now program, what happens is the loan is a silent second. So what that means is you don't make any payments on it until you sell the house or pay off the first mortgage. So it just sits out there in a second lien position. And when the first one's paid off, or again, you sell the house, refinance it, that's paid off. If you go with any of the government loan programs, it's a grant. So really awesome there. Expect higher interest rates with the grants, but you don't have to pay it back in the end. Montana Board of Housing, if you get the $10,000, you make monthly payments to it. The $6,500, you do not make payments to, but again, this is income restricted. HRDC, this $30,000, that's also silent second. Again, so it sits in a second lien position and you pay it off when you sell the house, refinance, pay off the first mortgage, that sort of thing. Okay.
Lily, we had another great question. This person asked, does interest accrue while in any silent second position, such as the Home Now?
Yep, great question. It does not. So they're a 0% silent second, so no interest on those. Yeah, excellent question, but no, they do not accrue on that silent second. Wonderful question. Alrighty, so let's talk about credit a little bit. I gave a credit presentation a couple weeks ago, and I believe that's on the library's YouTube channel. So if you have credit questions, it's a great slide deck to watch. We talk about some tips on how to improve credit, that sort of thing. Again, if you have any questions on any of this, don't hesitate to reach out to me directly. I'll have my contact information listed at the end. So I'm here to help. I'm passionate about this. So you guys are stellar for taking the class and taking the first step to learn about all of this. So mortgage credit. Some programs allow a 580 minimum credit score. However, other loan programs might be more like 620. Honestly, if your credit score is at 580, you're going to be penalized pretty heavily for interest rate. So I would say, maybe at that point, let's look at credit and see where we can improve to get those scores up. The target for a mortgage loan, not have any penalties on interest rate, is 740. So if you have a 740 and higher credit score, you are sitting in the sweet spot for a mortgage loan. So again, 740 is the goal. However, if you're below that, it's nothing to be real concerned about. If you have any collections on your credit, excluding medical, those need to be paid. So let's say maybe you didn't pay phone bill and it went into collections, that has to be paid. Medical, again, is the exclusion to this. If you have medical collections listed on your credit, those don't have to be paid to qualify for a mortgage. Just a note on collections, even if they are medical collections and they have a balance on them, try your absolute hardest to pay those off in full, because having a balance on a collection will decrease your score. So just a little credit tip there. And then really you need an established credit score. There are some options if you haven't established credit, but it just makes it a lot easier. You'll get a better interest rate if you have an established credit score. So if you don't have one, work on getting one established, and we can talk about some options. If you don't have one, chat with me directly and we can discuss those. Okay. So I always like to kind of go over do's and don'ts. So work with a lender that you trust. I talked about this earlier. Do you have that warm, fuzzy, feel good feeling with that lender? If so, that's a good thing. Work with somebody that you trust. I invite people to shop lenders. So if you're looking to get pre-qualified, go talk with a couple different lenders. Find the person that you trust. Again, trust, trust, trust. And then also that offers you the best financing. So, what loan program do they have you qualified for? What's the interest rate? Can you get any sort of down payment assistance if you want or need it? Shopping lenders is a big piece there. To kind of go back on the shampoo example, different lenders maybe offer different shampoo products. So again, just shopping those lenders, finding the best option that's available for you, being a smart consumer. Be prepared, have documents gathered for your pre-qualification. Again, so we're looking at those pay stubs, bank statements, tax returns, that sort of thing. When you are going through the transaction, if your real estate team, your lender, your real estate agent, anyone asks you for something, get them what they need as soon as possible. We are on a deadline to close, and any delay that comes from you getting us documents, that can push things out. So just be diligent, in that time frame that you're working to buy that house, to get the information to your lender or real estate team as soon as possible. Continue making all your payments like you have done on time. I don't know. Let's see. I don't think I have that listed. So we'll talk about that as well. So, continue making your car payment, continue making your credit card payment. If you have student loans, make every payment as you have done. Another big piece of this, don't go out and buy a new truck. Don't go out and get financing for that fun new furniture that you want to put in that new house. At a minimum, wait until the loan closes and you're fully owner of that house, because I haven't ever seen it happen, but I've heard of people, I'm buying a new house, I went and bought a new truck, and oh wait, now the new truck payment makes it so you don't qualify. So no new debts before you buy that house. Be honest with your lender about all aspects of your finances. So they're going to ask you questions. If you lie about anything, I can guarantee it will come up in surprising ways. Some don'ts: don't change jobs. I had that happen one time, and the borrower almost didn't qualify. So, they went to a higher paying job. However, there's lots of rules when you change those jobs. So maybe your new employer has, probationary periods. That's a big no-no. You want to keep everything as is from when you got qualified. Don't make any changes to your income. More or less can affect your pre-qualification. And so again, some of those down payment assistance programs have maximums that people can make. And if you start making more, you may not qualify for it. So again, try and keep everything as it was when you were pre-qualified. Again, don't lie to your lender about financials. It's going to come up somewhere in the documents, and it can cause issues for your pre-qualification. Don't make any major changes to debts, account balances, banking institutions. I had someone one time who said, they wanted to, I was banking at this bank and I wanted to change this one, wait until the loan closes before making any changes like that. Any account balances, if you have large deposits, talk to your lender beforehand. Again, no new debts or anything like that. And honestly, don't forget to stay excited. This is a huge accomplishment to buy a house. It's absolutely stressful. Yes, it is, but think of just the pride in homeownership and everything that you had to do to make that accomplishment. So, staying excited is a really big piece of it. So I will open it up to any final questions. Again, my contact information is listed there. So if you had a question you didn't want to, speak in front of the group, feel free to contact me directly. Just want to say a big thank you to the library for asking for Security Bank and myself to teach this class. And yeah, like I said, if you have any questions, fire them here, or send me an email, give me a call. I'm happy to help. So
Thank you so much, Hillary. This was really informational and wonderful. And for those of you who might have joined this a little bit late, this will be on the library's YouTube page. Like Hillary mentioned, her other presentation was. We're recording most of our programs right now, so you can get all kinds of good, interesting information. But we're open for questions. if you don't have any questions, I just would like to say thank you for joining us. Oh, we have somebody.
Woohoo.
If you're buying directly from the homeowner, does that affect the process?
That's a great question. So that would be like a for sale by owner transaction. Um, Honestly, I say, work with a realtor. So what happens with realtor fees or realtor commissions is they're paid out of the seller's proceeds from it. So you actually don't directly pay for it. I mean, you do in the purchase price, but you're not paying that realtor directly. Those for sale by owner transactions, I mean, you'd be navigating the buy sell by yourself. Realtors are trained professionals to, navigate that legal document with you and have the contingencies in place. So while it is possible, I have had first time home buyers, do their own buy sell contract. I personally, I'd want that warm fuzzy feeling knowing that somebody knew how to navigate through the document, knew the protections that were in place. I have seen some buy sell agreements come from online, and they don't offer the same protections as like the Montana standard buy sell agreement that's usually used. So it's definitely an option. However, working with a realtor, they're there to protect you. So yeah, great question. Another point on that. So any sort of seller financing, maybe like a contract for deed, like, hey, you pay me your mortgage, you can buy this house when you're done paying it off. Oh my gosh, be so cautious of those. I had the most horrific incidents one time where these borrowers had a contract for deed. They'd been paying this lady their mortgage payments for years. They come to me because they want to ultimately buy the house and get out of the contract for deed earlier, and they did not qualify for a mortgage. Their employment had changed. They were working very minimal hours, and they lost the house even though they had dumped, thousands of dollars into this house. So, just be extremely cautious if there's any sort of seller financing. If there is, work with an attorney, have them review the documents with you. That way, you are legally protected in that transaction. Yeah. Not to say a scary horror story, but yeah, just be cautious.
Do the same kind of rules then apply for like homes that have been foreclosed on?
No, foreclosure is different. So foreclosure means the ownership has then been transferred to the bank. I honestly have not closed on a foreclosure purchase just because there haven't been many. And, I think we will potentially see more depending upon, what happens with the economy. But from what I've understood, how that works is you go to your lender, get pre-qualified like you have done, and then just go under contract to buy that foreclosed house. Again, there's not an individual owning that house. It's a bank-owned property. So the buy sell would likely be between you and the bank. But again, I haven't done one of those transactions. If you wanted like more serious answers on that, I could definitely research it and get back to you on it. But it just hasn't come up in my career. So
Oh, no worries. I was just wondering. Thank you.
yeah, yeah, absolutely.
Do we have any other? These have been really enlightening questions and answers. Do we have anybody else wanting to share another question? Type it in there and we'll get to it. Otherwise, we might end a little early tonight.
Oh, I think we got another one. I love it.
What is the most expensive home you've helped buy?
Oh, well, I was working up in Big Sky for a little bit, and I got an inquiry for a construction loan. It was a $5 million build up in Big Sky. So it wasn't necessarily a buy transaction, but it was a construction loan. In our market, with as expensive as things are, it's not unlikely to see loans in what's called a jumbo loan. So there's actually a cutoff between what's called a conforming loan and a jumbo loan. Jumbo loans are harder to qualify for, higher credit scores, higher reserves. So how much do you have in savings after you put the money down for this house? Some of those ranches that you see are those really, really huge homes that, let's say they're listed for 22 million or whatever. Those might be on really large acreages where we actually have to do different financing for those. Maybe it's more of like a ranch where, there'll be income produced from it. But the largest I've done is the $5 million one. Yeah, good question. Expensive homes, right? Any others? I love all the questions. I wish you guys would keep asking them. Is the process different for buying land/property? Great question. So yes, no house. Okay, yep, so just vacant land. So that's a different loan product. If you're buying vacant lots or land, what you'd be looking at is either 25 or 35% down. So if you're buying a lot, let's say a lot in a subdivision, paved roads, utilities, you're looking at 25% down on that. For First Security Bank's current products is what I should specify. Land purchase, so vacant land, nothing done to it, you'd be looking at 35% down. You can't use any of the down payment assistance programs with those, so that's money that you'd have to come to closing with. And then the loan terms on those are a little bit different. They wouldn't be a fixed rate mortgage. We'd be for Security Bank products. We'd be looking at an adjustable rate or a balloon mortgage is what we currently have to offer. And we can talk about those details further if you're interested, but I don't think we have time to jump into ARMs, adjustable rates, or balloons tonight. But if you're interested, definitely give me a call or send me an email. So.
Okay, we have another question. What is the average, if you use the average amount of time that people spend looking for a home, what is the approximate time length of the whole process?
Oh, that's such a good question. And I get asked it all the time. And I wish there was a way that I could tell you exactly. It's so tough to answer that just because our market is really unique. Right now, inventory is low, so not a lot of homes listed. So right now, the challenges that we're seeing is homes are moving off the market so fast, right? And so just depending upon how quickly you and your realtor come across that property, that affects it. Some people, go and find the house right away and this is the one I want to buy. I would expect it with today's market, maybe 2 months, 2 to 4 months. Again, it's just really tough to say. On the pre-qualifications, if this kind of helps answer your question. So when you get pre-qualified with First Security Bank, your pre-qualification is good for 120 days. So about 4 months. And in that time, I've never had anybody run past that 4 months if they weren't seriously looking. If somebody just kind of came and was like, I kind of want to see what I qualify for, but I don't know if I'm serious about buying a house, they may have not found something in that 4 months. But if you're serious about looking, working with a realtor, I'd say it's probably pretty likely that you'll find something within that 4 month pre-qualification. So.
Great, thank you. Are there any more questions?
Is there anything in the chat over here? Let me just double check that. Oh, cool. Okay. Good questions there. All righty. Going once, going twice.
Thanks everybody for coming tonight. And thank you again so much, Hillary, for this great presentation.
Yeah, absolutely. Thank you.
Yeah. All right, everybody, have a good night. Enjoy the spring.